Hey investors, I hope you're doing well. It's that time of the month again where we will be looking at the undervalued REITs of September. Since the last video about a month ago, a lot has changed in the REIT space. Many of the most popular REIT investments have dropped significantly and some have even seen 52-week lows. With the increasing fear of further rate hikes, REITs are some of the most impacted companies by these decisions. This is because REITs are usually heavy on debt, and with debt maturing, they might have to refinance the debt at the current high interest rates. Today we'll be looking at some REITs that we think might be worth getting into this September. But before that, I'd love to hear what REITs you are currently buying. Let me know in the comments, and if you're new here, on this channel we make regular videos about dividend stocks and much more, so make sure you subscribe if you don't want to miss any videos. The first company we'll be talking about today is Mid-American Apartment Communities, stock ticker MAA. Mid-American Apartment Communities is a real estate company that specializes in the development, ownership and management of apartment communities. Their primary focus is providing high-quality residential options for individuals and families in various regions. Their properties are located in areas where demand is increasing. As we can see here, many Americans have been moving to areas like Texas, Florida, Tennessee and the Carolinas. These areas are places where apartment REITs have been seeing greater demand. Mid-American Apartment Communities is one of those REITs that has many properties located in the middle or south of the United States. This being a massive advantage for MAA is something that we can confirm looking at similar companies in the sector. Avalon Bay, for example, is another apartment REIT, but they are located in the west and east coast. In one of their latest reports, they have marked places in Texas and Florida as their expansion regions, which once again shows the interest and demand in this area. Even with these competitive edges, the price action has been looking very great. The stock is down over 11% year to date, and over the past 5 years the stock is up almost 33%. This compared to the S&P and the Nasdaq means that they have underperformed significantly over the long run. This however might mean that there are opportunities to get into a position at an attractive price. Looking at the dividend summary, currently they offer a dividend yield of 4.06% and they have been growing this dividend with an average of 8.4% in the past 5 years. You would usually say that the dividend is very safe seeing as the payout ratio is sitting at almost 61%, but for REITs there is a different metric that needs to be used. Instead of using the net income payout ratio, we must look at the payout ratio based on the adjusted funds from operations. For MAA, this is sitting at a forward ratio of almost 68%, meaning that the dividend can be deemed safe. And they have been increasing their dividends for 12 consecutive years. If we perform a valuation with our REIT valuation model, we can see that with our various models like net asset value and discounted dividend, we get a fair value of $177, but that is not it yet. After this, we apply a margin of safety that is based on the health of the company, that for MAA we have sitting at 10%. With this, we're left with a fair value of $160.75, which is under the current price of the stock, indicating that's currently undervalued by over 16% based on our valuation. And by the way, if you want to get your hands on this valuation spreadsheet that is used for all REITs in this video, together with a bunch of more other sheets, you can visit my Patreon, which is linked in the description. The second REIT that we'll be looking at today is WP Carey. WP Carey is a REIT that specializes in owning and managing commercial real estate properties. They primarily engage in sale, leaseback and net lease transactions, providing businesses with capital by purchasing their real estate assets and leasing them back. This allows companies to unlock capital tied up in properties, while WP Carey generates income from long-term lease agreements. 2023 has been a rough year for WP Carey in terms of price action. The stock is down by more than 18% year to date, and even in the long term, if you bought the company 5 years ago, you'd still be down almost 3%. Looking at our dividend summary, we can see that they currently have a dividend yield of 6.7%, which is a very generous yield compared to its peers. Even with this solid starting yield, WP Carey has also been increasing their dividends by an average 1% annually in the past 5 years. The dividend is relatively safe, seeing as their adjusted funds from operations payout ratio is sitting at just over 83%. This is, however, quite a bit higher than the other companies in this industry, so I wouldn't be surprised if they won't be able to keep up their dividend growth rate currently. Since 1998, WP Carey has been paying dividends, and these payments have been going up quite a bit over the years. And with this dividend history, they can call themselves a dividend aristocrat with 25 years of consecutive dividend increases. If we look at their tenant portfolio, we can't say anything other than that it's looking very strong, with solid companies like Metro, Advanced Auto Parts and Marriott being some of their tenants. WP Carey can assure itself that it will be able to maintain their cash flow generation from properties. Looking at our valuation spreadsheets, we get a fair value out of our models of $85.05, and once again we will be applying a margin of safety, which for WP Carey we have sitting at 15%. Applying this margin of safety gives us a fair value of $73.96, which, with the current price of $63.82, gives them an upside of almost 16%. The next company we'll be looking at today is Alexandria Real Estate Equities. Alexandria Real Estate Equities is a REIT focused on owning, developing, and operating life science and technology campuses. They provide specialized properties and infrastructure to support innovation and research in life sciences, healthcare, and the technology sectors, catering to tenants like biotechnology and pharmaceutical companies. Just like many other REITs, Alexandria Real Estate has seen poor price performance in 2023. Year to date, the stock is down over 20%, and in the long run we see a similar performance, with the stock being down almost 10% over the past 5 years. As for dividends, ARE is currently offering a solid dividend yield of 4.31%, and in addition to this, the company has had very nice dividend increases with a 5-year growth rate of over 6%. Their dividends is looking pretty safe, as the AFFO payout ratio is currently sitting at 70%, which is slightly lower than similar companies in the industry. Alexandria Real Estate had to do a massive dividend cut during the 2008 financial crisis. Back then, they cut their dividends from 80 cents a quarter to just 35 cents. However, after this period, they started to increase their dividends again. And as of now, they have 12 consecutive years of dividend growth. Taking a look at our valuation spreadsheet, we get a fair value of $165.42 out of our models, and just like before, we have determined a margin of safety, which in this case is actually sitting at 25%, seeing as the financial health and growth of the company have not lowered the margin of safety by as much. Applying this margin of safety gives us a fair value of $124.06, and with the current price of $115.01, means that the company is undervalued by almost 8% based on our analysis. The fourth company we'll be looking at today is Agree Realty, stock ticker ADC. Agree Realty specializes in acquiring, developing, and managing retail properties throughout the United States. The company focuses on providing high-quality retail spaces to a diverse range of tenants. Their portfolio includes properties in various retail categories, catering to the needs of both national and regional retailers. So far this year, Agree is down by almost 15%, and over the long run, Agree has seen a price increase of just under 10%. It seems to be a recurring trend with REITs that they underperform the major indices, but keep in mind that we don't take account dividends into this. And speaking of dividends, Agree offers a dividend yield of 4.83%, and similarly to companies like Realty Income and Stag, they pay monthly dividends. As for the growth rate, this is currently not looking too shabby either. The 5-year average growth rate in the dividends has been sitting at 6.7%, and since they've started paying monthly dividends, they increase their dividends every 6 months. If you look at the dividend history, we can see that in 2021, Agree started to pay monthly dividends, and before that, we have also seen pretty nice dividend increases all across the board. Agree puts much pride into the fact that they have a high amount of investment-grade tenants, and this is something not to sleep on. Their tenant portfolio consists of high-quality companies such as Lowe's, Walmart, and Home Depot. With such tenants, you can be assured that Agree will continue to receive rental income from these companies even during the toughest of times. Once again, we have performed a valuation for this company, and out of our valuation models, Agree got a fair value of $80.39. With Agree having some positive and negative financial factors, we're left with a margin of safety of 15%, and applying this margin of safety, we get a fair value of $69.90, which is almost 16% higher than the current price. The last company we'll talk about today is American Tower, stock ticker AMT. American Tower is the largest REIT that owns and operates communication infrastructure, including cell towers and rooftop sites, and their presence is global. The company provides critical infrastructure to support wireless carriers and telecommunication companies, enabling them to expand and enhance their wireless networks. American Tower has seen a significant downturn in price action this year. The stock is down by almost 16% year to date, but in the long term, it's actually up by around 23%. As for dividends, AMT offers a lower starting yield than other companies in the sector, such as Crown Castle, but in return you get an amazing growth record, which in the last 5 years has been sitting at 16.42% average dividend growth rate. And we can't complain about their dividend safety either. Their current AFFO payout ratio is only 65.66%, which is quite a bit lower than the sector median. This means that there is plenty of room left to increase dividends further. The tenant portfolio of American Tower is looking nice, with their main tenants being companies such as AT&T, Verizon, and T-Mobile, who are companies you can definitely rely on being your tenants. As per our valuation models, we get an average value for AMT of $231.38 a share, and applying our determined 15% margin of safety, we get a fair value of $201.20. This means that per our valuation, there's still an upside left of over 11% on this stock. And that wraps it up for this video. If you haven't seen my previous REIT stock analysis on Realty Income yet, you can click on the video right over here. And if you want to be notified whenever I upload, you can hit the subscribe button down below, and I'll see you on the next one. Thanks for watching.